In this series of videos, I'm going to explain to you how different financial products work on Wall Street. I'm a lawyer with 25 years experience in the financial markets. I've worked in mergers and acquisitions, derivatives, futures, options, swaps, crypto, you name it. And I want to put these videos out for those of you who want to work in the industry or just understand what's going on and get a better handle on it. And we'll get started with forwards. If you look, there's a lot of very different complex financial products like futures, options, crypto, swaps, swaptions. And the way to understand them is to think about who's it for and what's it for. And they all build on one of the oldest financial products known to man, the forward contract. So what is a forward contract? A forward contract is a contract between two people to sell an asset at a specific price on a future date. So if she agrees to sell him this house in 6 months' time, is that a forward contract? So a contract between two parties for a specific price at a future date. So yes, it is a forward contract. However, in the financial markets, these instruments usually deal with commodities. So a house is something that's unique. If I have a contract to buy that house, I don't want any other house, I want that house. But if we look at these $2, they're actually sequential, right? One was printed right after the other. And if I asked you to borrow $1 and you gave me this dollar, and then a week later I gave you back this dollar, you wouldn't look at the serial number and say, that's not the dollar I gave you. I don't want this dollar. I want this dollar, which is the one I gave you. $1 is the same as any other dollar, and that's called fungible. So commodities are fungible, and one is just as good as the other, and that's what forward contracts, futures, and other financial instruments are almost always based on, is things that are fungible. So when I say these contracts are very old, I'm not exaggerating. When writing was invented, it was used for forward contracts. So the earliest writing we have were actually financial transactions. And even in Hammurabi's code, the one about an eye for an eye, most of the rest of Hammurabi's code deals with things like interest rates and what types of commercial terms are acceptable. So commodities and forwards have always been a part of human history as long as we've been around. So again, a commodity is interchangeable with any other of the same type. Apples for apples, oranges for oranges, but not apples for oranges, and not one house for another house. I'm going to show you a clip from one of the only movies in Hollywood that deals with commodities trading, and that is Trading Places with Eddie Murphy.
We are the commodities brokers, William. Now, what are our commodities? Commodities are agricultural products, like coffee that you had for breakfast, wheat, which is used to make bread, pork bellies, which is used to make bacon, which you might find in a bacon and lettuce and tomato sandwich.
And that's 100% right. However, in modern times, most of the trading that goes on does not involve agricultural commodities like this. Most of the trading, more than 90%, is financial commodities like foreign currency, interest rates, things like energy, oil, natural gas, gold and silver. It's very little agricultural now. As we said, if a buyer and seller agree to exchange something in the future, that's a forward contract. So I had AI make this up, which is why this looks like nonsense. But here we have a farmer and he's selling wheat to a baker. Now, both of these people have a problem. And the problem is that the price of commodities tends to go up and down a lot. So here's a 5-year chart for orange juice. And you can see in 2002, it would have been $121. In November of 2024, it would have been $548. And 6 months later, it's $250. So just in this 2-year period, it went from 200 to 500 something down to 250. So it doubled and then it halved and it had a really bumpy ride along the way. And that's because commodities depend on things that are completely out of your control. So agricultural commodities depend on the weather, and the price that you get will depend not only on the weather and how good of a farmer you are, but also how good at farming your neighbors are. So if you have a great crop and they have a great crop, there's a lot of the crop out, and then you'll get a low price. If you have a great crop and they have a terrible crop, the price might go down and you'll make a lot of money. If you both have a terrible crop and so does everyone else, the price will go up, but you still might not make any money because you had a terrible crop. So there's a lot of things outside your control. So back to our example, he likes to sell wheat to her, and she's a baker. And she likes to sell the bread to a supermarket. If she's got an agreement to sell 10,000 loaves this year to the supermarket at a fixed price, and all of a sudden this year the price of wheat goes way up, she's going to lose a lot of money, and the farmer's going to get rich. But if the price goes down a lot, she's going to make a lot of money, and he might go bankrupt. So she is really good at baking, but not good at predicting the price of wheat. And he's really good at farming, but not good at predicting the price of wheat. So he wants to make money, she wants to make money, and the supermarket wants to make money. And one way to do that is to agree to a price in the future. So the supermarket already agreed to buy her bread at a certain price, and she can lock in the price with him with a forward contract. So he's going to agree to sell her the wheat at a certain price, and whether the price of wheat goes up or the price of wheat goes down, it's not going to make a difference because they already agreed on the price. So he could make more by waiting and not locking in the price, but he could also lose more. And the same thing with her. And they don't want to make more, they don't want to lose more, they just want to be certain so that they can focus on their business, which for him is growing wheat, and for her it's making bread. And if they can lock in that price, they can get back to what they're good at and not worry about what's going on in the markets. And that's what a forward contract does. It lets you lock in that price and get certainty. People love certainty. That's why people love certainty. That's why they love fixed rate mortgages. And they like to have jobs with a set salary, not one that's based on a commission or how well the economy is doing. Certainty lets you plan for the future more certainty lets you plan for the future more effectively, and forward contracts are a part of that. So that's why forward contracts have been used for literally thousands of years, and we still use them today. But why do we use the other financial products? Well, there's a problem with forward contracts. Let's say that the price goes up or down a lot in 1 year. If they agreed upon this price and the price went up a lot this year, then she's going to be able to buy it for a lot less than she could in the open market. But the reason the price went up a lot is probably because other farmers had a bad crop. And what if he's one of the ones that had a bad crop? And when the time came to deliver the wheat, he said, I don't have it. And he looks like an honest guy. So he says, you know what? I'll give you twice as much wheat next year. But next year isn't going to help her because she's got to give the wheat to the supermarket this year. And there's another problem. What if he does have the wheat, but he thinks he can get more for it by selling it to somebody else and says, I know we have a contract, but I'm not going to honor it, so go ahead and sue me. And the same thing can happen if the price of wheat goes down a lot and they agree to a certain price. She could say, I'm not going to honor that contract and you can just go ahead and sue me. Pretty soon what's going to happen is that bakers that have a reputation for honoring their contracts are going to be able to get better prices on wheat from farmers, and farmers that have a reputation for honoring their contracts are going to get better prices from the bakers. And then other people that don't have that reputation are not going to be able to use these contracts at all, or they're going to get charged higher prices. So if you're a farmer that doesn't have a reputation yet because you're new in the industry, or you have a farmer with a bad reputation, you can go through this guy and agree to sell him your stuff, and then he can go to her, and then she's not relying on your reputation, she's using his reputation. And if he does that for enough people, he sort of becomes like an exchange, and that's where futures eventually evolved. And we'll go into that later. But this is what forwards are. This is the problem with forwards, and futures and other financial products that evolved out of forwards are the solution, but they all build on forwards. So you need to understand forwards to get to the rest. So hopefully that brief introduction helped you. Just like and subscribe, and I'll be putting out more of these videos soon.